We have a strong contender in the middle of the madness. Just hold on. So it truly is a good thing, and I always wanted you to know there is always this, and this is everlasting. Just hold on. It's about faith. It's about trust. Yeah. It's about faith. It's about trust.
Hola, muy buenos días a
Good morning, everyone. My name is Ignacio Rodriguez, responsible for M&G in Spain, and I'd like to thank you once again for attending an annual investment meeting. It's a pleasure to see that there's so much interest in it, especially at this time of the year with great volatility in the market since 10 days ago, and data that will be published today. I'm sure that during the cocktail, we will get the U.S. inflation data. There are lots of people, lots of investors, trying to see whether inflationary pressures confirm in the U.S. Even before the markets became volatile, we had already decided to introduce three ideas that we believe make a lot of sense this year, a year that can be considered as an end-of-cycle year for fixed income. And we have to be very flexible to adapt to what your clients will demand and what markets will require. We'll start talking about multi-assets. One of the funds that is in the multi-asset platform in the allocation range. It was launched in 2016. It's called Global Target Return Fund. It's a total return fund that wants to beat the Euribor plus 4.5 points. We have with us its manager, the fund manager, Tristan Hansen, who will give us an overview of this market and the way he manages this fund, where expected returns and volatility are two of the main focus of interest. One of the ideas that we believe is clearest in a synchronized global growth scenario is emerging markets debt. It's a best idea fund that invests both in corporates, in strong currency, and in local currency. We have Charles de Quinsonas with us, Deputy Fund Manager, and this is one of those ideas that we believe makes a lot of sense in portfolios. Finally, we have the Japan Fund, Japan Equity. Those of you who've been in the market for years will know that there have been lots of disappointments with Japanese equities, but we believe in Japan a change is taking place, a structural change. Company managers are paying more attention to retailers and retail investors. And then we have Abe with his economic policies, who seems to be getting Japan out of that long deflation period with very low growth rates. We will try to close around 1:30, and we will have a cocktail that I hope you will join us for. Tristan, can you please join me here in the podium? Now, Tristan is going to present the multi-asset absolute return investing philosophy that we believe makes a lot of sense. In January, the return was 5.3%, so up to the expectations we had when it was launched in December. And I wanted to remind you, and you can see it in this slide, that in 1, 3, and 5 years, how many multi-asset M&G funds are in the top quartile, second, third, and fourth quartile? 5 years, not so many, but in terms of 3 years, in terms of volume, I would say that 90% of the volume we manage is in the first quartile. So they've been very successful funds. We're now amidst migration to the allocation range in Luxembourg. If you have any doubts or any questions about this migration, please talk to us during the cocktail or send us an email, because we don't want to cause you any problems, nor your clients. The multi-asset investment teams manages over 17.2 billion euros. It's one of the groups that has grown the most over the last 15 years, and we believe it's a type of investment that can make a lot of sense in these times of volatility that are to come. Very flexible funds that can adapt to each moment in the market, that may be even negative in duration, which invest in indices that can move very fast from one day to the next. So I believe it's one of the strategies that will make more sense in the next few years, and it will be a good alternative to benchmarks and indices. Tristan joined M&G in 2016 as a fund manager. He was responsible for the launch of the Global Target Return Fund. Before, he was head of asset allocation in Ashburton, and he was also strategies at Casinovi. He knows the field very well, and he's going to talk about the fund. You have the floor.
Buenos días. Es un placer para mí estar.
He's speaking in Spanish now.
Madrid, una gran.
It's great to be here in this great city of Madrid, a great city for culture and sport. My family is from Birmingham, where we have the Aston Villa and Birmingham City, but we don't have a Real nor an Atletico.
That is where my Spanish will end for today. So thank you, Ignacio. Thank you for having me here today. It's my pleasure to introduce the Global Target Return Fund to you. As Ignacio mentioned, I work on the same team as, well, the rest of the multi-asset team. Juan Navarro, I'm sure you know very well, and I'm sure you're familiar with some of the funds that we have highlighted here. So on the left-hand side, we have the long-only funds, so conservative allocation, dynamic allocation, and the income allocation funds. Now, these funds, which I'm sure you're familiar with, these will always have exposure to the various asset classes. So they will always have some exposure to equities, they will always have some exposure to fixed income. On the right-hand side are the alternatives within the range, the absolute return funds, and these two funds on the right-hand side have a neutrality of 100% cash. So full flexibility to be long or short in different asset classes. The Episode Macro Fund is seeking higher returns and will tolerate some higher volatility. And the fund I am managing is the Global Target Return Fund. And we've launched this fund because we believe that, well, we believe in what we do from a asset allocation and investment process point of view, but we believe there was a space in the market for our approach, but in a more volatility-constrained way, so a lower volatility version of what we're trying to do. As my colleague Borja was saying, I need to be the Fernando Redondo of the team, rather than the Cristiano Ronaldo. In terms of the objectives of the fund, I'm trying to deliver Euribor plus 4%, gross of any fees, measured over a rolling 3-year period. So we're trying to make positive returns regardless of different market conditions or whether equities or bonds are in a bull market or a bear market. And we're trying to manage the volatility of the fund as well. The expected volatility is between 3 and 7%. And part of the risk management process as well is around trying to mitigate the level of drawdown that one might get in short-term market disruptions, a bit like what we've had so far this month. As I mentioned, a neutral allocation is 100% cash. These are the permitted ranges in which I can move. So for equities, I can be as high as 35% or at minus 35%. And for fixed income, I can have 6 years duration positive or 6 years duration negative. And there is an allocation, should I choose to use it, in some alternative areas. So they could be asset-backed securities or infrastructure. So it's a macro-based fund with a very flexible mandate. I'm not so much trying to make money out of individual stock picks. It's about getting the asset allocation right and or looking at various macro themes where we think pricing is attractive. Now, in terms of the approach, if you've heard my colleague Juan present, or Dave Fishwick, or other members of the team, you'll be very familiar with our approach to macro or multi-asset investing. We have two main components to what we are doing. The first part is the valuation component, and I'll talk in more detail on that in a second. The second part, which I think is quite a unique approach that we have, is around identifying what we call episodes. So periods when market prices are moving in a dramatic fashion, which we don't think are justified by any major change in fundamentals. Often during these periods, emotions are dominating investor thinking rather than a cold assessment of the objective facts. And a classic example of this for me, which was very successful last year, was the Mexican peso. So the Mexican peso fell very sharply when President Trump was elected. It fell 20% from November to January. And we thought, you know, this is an episode. This is price driving emotion, fear. People weren't looking at things in a rational fashion. Normally, when you're looking at the valuation of an exchange rate, you're thinking about things like interest rates, inflation, productivity. The exchange rates don't normally move 20% because somebody might build a wall or not build a wall. So that was a very cheap valuation and a good opportunity for us to profit from buying Mexican bonds in December 2016. And that is that's where we get our tactical ideas from. And then hopefully the aim is you have a portfolio, a global portfolio, investing in different asset classes and executing using different instruments depending on what we think is the most appropriate way to implement. So we could get equity exposure through index futures, through options, through ETFs, direct stocks, or even owning an internal fund. This is the valuation assessment that we do. We rank all the asset classes, starting with the sort of safety assets, so cash and G7 government bonds, and we move across through to credit, through to developed market equity, and through to emerging market equity. And the grey band that you see is our assessment of neutrality or an equilibrium valuation for the asset class. What we're plotting is the real yield, so the real expected return after inflation for the individual assets. Now, clearly, this varies dramatically over time. If you go back to 2000, you could get a 4% real return from US Treasuries. They were yielding around 6%. And equities were extremely expensive. So in 2000, you'd have seen developed market equities below that line of neutrality, and you'd have seen cash and bonds very high relative to neutrality. So the asset allocation decision 17 years ago was very much pro-fixed income and anti-developed market equity. The situation today, as has been the case for several years, is that prospective returns from fixed income assets are extremely low, and in fact they're likely to be negative after inflation in most developed market bonds. The one area of bonds that we think is more attractive is emerging markets. I'll come on to that in a moment. Equities, we think, are reasonably valued to offering good value compared to cash or fixed income. So our stance, certainly since I've been at M&G, which is just over 2 years, our stance has been very much pro-equity and negative on government bonds. The key question, I think, at this stage of the cycle is whether these cash rates need to rise significantly, in which case that would pressure certain other asset classes as we move along. But we can talk about that as we go through. So you've seen the two ways I try and generate ideas. We have the valuation framework, and we have the behavioral part, which is trying to identify tactical opportunities. Clearly, for my fund, risk management is also very, very important, because my fund is intended to be the one with the lowest volatility in our multi-asset range. We have 4 pillars to our risk management approach. The first one is value at risk. Now, we all know that value at risk comes with a lot of problems, so we mustn't rely just on value at risk. Stress tests, to be honest, are the most important from my point of view. So we want to look at how is the portfolio going to perform if we have another Lehman's crisis, or if we have another taper tantrum, or September the 11th. And so we look at how the portfolio holds up in those scenarios. Obviously, nothing ever happens exactly the same as it did before, but you're trying to gauge a range of potential downside scenarios. We look to try and contain losses over 1 month to no more than 3%. We think for this type of fund, over a 1-month period, that is quite a big move to be tolerating. So that is the level of caution we have with this fund. We monitor the volatility on an ongoing basis, we monitor the correlations, and the final part, which is different to the other funds again, is if the portfolio is down 1.5% within a calendar month, we have to have a formal review with the risk team and discuss, are our ideas, why aren't they working out as we hoped? What is going on? Are we in danger of more downside? And so we have a strict risk management process around this. Okay, so if I may, I might just spend some time talking about last year and then perhaps what the long-term future holds for multi-asset investing. Last year was another classic year when people were hugely surprised. If you look at here, we have the FT arguing that Trump is going to lead to a strong dollar. That was the editorial of the FT. The FT investment panel, their expert investment panel, They were saying in December 16 that our panel did not agree on everything, but they were united in their view that volatility will return to global stock markets in 2017. Now, clearly we had some volatility more recently, but 2017 was a year of record low volatility. So our approach is not based on forecasting. We think forecasting macro is likely to be a fundamentally flawed approach to investment. Because why should anybody have a better ability to forecast than anybody else around the room? We all have the same technology, we all have smart people. What we need to do is to work out what is priced and then to think about where the surprise will come. So our approach is not to forecast, it is actually to spend our time trying to understand what is happening in the world already, to try and gauge people's mindsets, and then to think, okay, people are going to be surprised. Are they going to be surprised because the world turns out to be better than they thought? Or are they going to be surprised because things turned out to be worse than they thought? So this is our line of reasoning. We get away from forecasting or thematic investing. I think that's very problematic. We start with prices, and we start with valuations, and we start by thinking about what do other people believe and how will those beliefs change. So going back, what was, we thought, a crucial moment was the middle of 2016. Now, what I show in this chart is the expectations of economists for global GDP growth. So it's the average of all the economists out there forecasting GDP. Now, you can see what happened here. So if you look at 2014, so that line represents the forecast for the year 2014. And it shows, the graph shows how the forecast changes over time. They came in trying to predict 2014, and they said 3.2% growth. And we went through the year, growth was disappointing, it came in at around 2.6, and they were surprised on the downside. They came back to 2015, again, the economists had a kind of subconscious view that 3.2 is the level that the economy should be growing at. Their forecast was identical at the start of 2015 as it was to 2014. And then through the year, 2015 was a surprise as well, downside surprise. They come back for 2016, exactly the same again. 3.2, roughly. And then we go through 2016, we have fears about China, worries about a global recession, and the icing on the cake was Brexit, and all economists just threw in the towel, and they said, things are never getting better. And all the talk was about secular stagnation. And so there was this idea that bond yields would never rise, interest rates would never rise, we were in deflation, secular stagnation. We felt that this was a massive overreaction and not in tune with the actual reality, the observed facts. And what we've seen ever since that point in time is these people have been revising their forecasts higher. And you can even see for 2017 and 2018, if you look at the starting point of that line, they had subconsciously become more pessimistic. They had already reduced the level of global growth that they thought was the long-term average, and they've been surprised and they've been revising it up. So this has been, and you can see the headline from the Telegraph in April 2016. So we've had 18 months of very positive surprises in terms of global growth, partly because people became so pessimistic. This was happening at a time when relative valuations were very favorable for equities compared to fixed income. So these lines are the same bars you saw in the previous chart, but just plotted over time. I mentioned to you 2000, you were getting no equity risk premium whatsoever. Since the global financial crisis and since the euro crisis, equities have been offering much better value than government bonds. And that remains the case today. So that is why generally our asset allocation is to favour equities over government bonds. The interesting thing going forwards is, are government bonds going to become a source of risk to portfolios rather than something that dampens risk? And this goes back to that. So this looks at the last 10 years of returns from global equities and global bonds. And it's kind of an amazing chart because it shows that this goes up to the end of 2016. It didn't really matter in that decade whether you own bonds or equities, as long as you own something. A 70-30 portfolio did the same as a 30-70% portfolio. Quite astonishing coincidence, really. What happened through this period is that bonds did far better than anybody imagined they would do. So people often own bonds as a safety asset, as an asset that should do well if their equities do badly. What happened was, not only did bonds do well when equities did badly, but bonds did very well, generating high returns throughout the entire period. Our argument is that this is unlikely to continue. And if you look at the returns on bond indices over time, adjusted for inflation, you can see actually now, for more than 5 years, you've made no money in US Treasuries. Made no money after inflation. In Germany, this is now nearly 3 years, and in the UK, it's a couple of years. So the question we all need to ask ourselves, is the future going to look like this upward trending line, or is the future going to look flat, like you see in this chart, or possibly even to the downside? If you look at valuations, they're indicating that returns from government bonds are likely to be negative after inflation going forwards. The one area where we do think bond markets are more attractive is in the emerging market space. Now, on a short-term view, you might, you want to watch how emerging market bonds react if US Treasuries are selling off or if German Bunds are selling off. But I think from a medium-term point of view, this is quite a good area to have exposure to. Okay, so how's that reflected in the fund? I must thank my colleagues for my slide. This is, don't worry, I haven't been spending 6 months doing PowerPoint training. So somebody else did this, so I was very impressed. So in terms of the relative weights in my fund, I've got a moderately positive position on equities, but it's not a particularly aggressive position. If this sell-off intensifies, then there'll be scope, once it settles down, for me potentially to add more equities. But you can see the interesting thing on the bonds is that I've had very negative duration on bonds. So I've had negative positions on treasuries, German Bunds, French bonds, and Japanese bonds, offset with positive positions to some extent in emerging markets and some areas of the periphery as well. So Portugal was a very strong performer last year. Credit, I don't really have much of a position on credit anymore. I've been reducing my credit exposure because I think spreads are reasonably tight. And the alternatives, I've got a small exposure to infrastructure and asset-backed securities. So that is to try and get some yield in the portfolio, given that I don't have much in the bond market. And so, if you put that together in terms of themes, we think equities are more attractive than the other asset classes, so you want some upside exposure to equities. We think emerging markets and emerging market currencies offer some quite good carry, so high interest rates. For income, we're looking at infrastructure, asset-backed securities, and let's say emerging market debt. Then you see the protection from the rates point of view. So January was a very good month for me because bond yields were rising, and that's an environment that my fund has done well. So, as an alternative possibly to having a defensive fund invested in bonds, if you don't like bonds, this might be an interesting place to look. The final part about China, and this goes back to the forecasting, China clearly has done better cyclically in the last 2 years than was the case in the 3 or 4 years prior to that. There are, however, some big structural issues in China with regards to the build-up of debt and just how opaque the financial system is and the policy-making situation as well. So there is some protection in there. It's not a forecast, but I have to recognize that China is a potential source of risk. That doesn't stop me owning Asian or emerging market equities, however, because I think they've been good value. So I'd rather own assets I think are attractive and then look for areas to protect myself where protection is less costly. And so in terms of characteristics of the fund, you can see I've had a modestly positive beta with global equities, so a beta of 0.2, and a beta with global bonds of minus 0.6. So we've been doing well when bonds have been doing badly. And just in terms of performance, I'm happy to say that the fund is on track with the objectives. Clearly, this is a very short time horizon. The objective is over 3 years. So 3.4% last year. January up 2%. Given a little bit back, around 80 basis points in February, but on net, still positive so far this year. In terms of where those returns came from last year, equities were a strong contributor, emerging market bonds, corporate bonds as well. And then last year, which was a year really when nothing really went badly wrong, there weren't major episodes like we've seen so far this year, then the protection will be a drag on the portfolio in those periods, but you hope that when perhaps some of the riskier assets are doing well, that the protection strategies will compensate and do better. And in terms of the risk parameters, when volatility in the market is low, the risk parameters on this fund should be low, because we all know that volatility will pick up at some future date, as we're witnessing this month. So I think one thing to be very clear on is that I'm not trying to target a constant level of volatility, because volatility changes in the market, and if I'd been targeting 6% volatility in this recent phase, then the drawdown would have been much larger. So I've been more conservative when times are calm, and then naturally, even with the same portfolio, you'll be appearing more aggressive in more volatile conditions. Okay, so that really is the summary of the fund. The objective is Euribor plus 4, gross of fees. It's an outcomes-based fund. It should be a safe haven relative to some other strategies, and maybe an area people could think about if they're no longer so positive on bonds. It's the same process and philosophy as the rest of the team, but with a different risk management element to it. So on that note, I'm happy to conclude, and perhaps Ignacio come up and maybe there'll be some questions. Thank you.
¿Alguna pregunta para Tristan?
Any questions for Tristan? I have one.
In the last week, how you changed your portfolio?
Yes, so in January I did cut some equity and some of the call options because markets were moving very quickly to the upside. The fundamentals hadn't changed in January, but the markets got very excited. So I took some equity down a little bit. I had call options that had been doing well. I closed those. And also, US Treasuries have had quite a large move. So I've taken off my positions on US Treasuries. I'm still short in Europe and Japan on the bond side. But I've kind of gone neutral in US, because I think in these phases, it's very difficult to know how correlations are going to move. Things can do unexpected things. And the danger is, if you have a portfolio with lots and lots and lots of positions, you have a lot of risk because you have a big balance sheet and things move in unexpected ways. So I've been trying to bring the portfolio in see how things move, and then hopefully there'll be some opportunities to redeploy capital.
¿Alguna pregunta? No? I have the last one then. Talking about dollar, you show what the FT was thinking at the beginning of 2017. Do you have any views on dollar? I know that you don't like to do forecasts, but do you think that dollar should appreciate due to the changes in Federal Reserve and maybe higher interest rates?
I mean, to be honest, I've been surprised how much the dollar has moved, really. I suppose the growth surprise has been more positive outside of the US. So compared to 2 years ago, things are much better in Europe, and things in the US are a bit better. So there's been a bigger surprise. So I think that's part of it. Currencies really can do very random things in short periods of time. So I'd rather wait. I mean, I have a small position in the dollar, not very large, but I would rather, before making a big move, wait and see if we get to some extreme, and then you've got a better chance. When things are moving around in the mid-range, they can kind of do anything, really.
Okay. Okay. Thank you very much, Tristan.
Okay, thank you, Ignacio. Thank you.
Bueno, vamos a pasar al segundo fondo.
Let's go on with the second presentation for today on Emerging Markets Bond Fund. Charles de Quinsonas, his deputy fund manager. Some data about the fund first. The fund was launched in October 1999. It was managed by Claudia Kalik since December 2013. Charles is a deputy fund manager, as I said, more than 45 million being managed, and particularly, I mean, the yield to now would be more than 6% gross performance. But among all these types of funds, it's certainly the one with a major theoretical performance. It has been a very good development, as you can see in the last few years, 16 and 17, 8.7 and 10.5. And if we compare it with the reference index, which we have, in the last 2 years, since 2013 is better than the reference margin. Now, it is a fund which is quite meaningful right now. This is the evolution in dollars as compared with the Morningstar Global Emerging Market Bond, and it will be presented by Charles. Charles joined the M&G in May 2014 as an emerging market corporate bond specialist, and he was appointed deputy fund manager at the end of September 15. He's also deputy fund managers in a strong currency in another fund which combines bonds as well as equities, so it is quite attractive. He's got 8 years of experience in emerging markets, and with Claudia John, it's a very, very good team indeed. Charles.
Hello, everyone. It's a real pleasure to be in Madrid with you today. I know there is a big football game tonight. I'm French, but I'm not a football fan of Paris Saint-Germain, so no worries. Even if the result is bad for Real, you still have a reason to invest in the fund, please. But I'm not here to talk about football. I'm here to talk about emerging markets. And I have 20 minutes or so to talk about fundamentals, technicals. I'm sure you want to hear about the Fed, about flows, and is there still value in the asset class at this level of valuation? So I'm going to try to talk about all of this. and start with fundamentals, because this is, as you know, fundamentals always catch up on technicals. And remember what happened during the period 2013 to 2016. You had a number of countries in emerging markets like Russia, Brazil, having negative growth in recession, basically. We had fears about China, Chinese growth. Is this sustainable? Is this viable? Since 2016, we have seen a rebound in growth across all emerging markets. I'm not here to tell you that emerging markets are perfect. There will always be poor fundamentals in some countries, namely Venezuela, Mozambique, and other countries. But across the board, since 2016, we are seeing a rebound in growth. This is the latest IMF projections, so they're dated January 18, which include this year forecast and next year. If the IMF is right and we continue to see growth across emerging markets, this will be very positive for credit in particular. On this chart, what I'm trying to show you is the correlation between credit quality, which is represented here in the green line, which is basically net credit rating upgrades minus downgrades. And you can see a correlation between credit quality and growth. So if the IMF is right, and we believe there is a rebound in the macroeconomic environment in emerging markets, we should see going forward more upgrades than downgrades. The improvement in the macroeconomic backdrop is reflected in corporate earnings in emerging market corporate issuers. We've seen higher top line revenues, higher EBITDA, and lower leverage. And this is the first time, and I've been covering the EM, emerging market corporate bond market, for 8 years, and it's the first time in almost a decade that we're seeing leverage coming down. Finally, from a high level, emerging market corporates have increased debt levels, and in particular China, and I'll come back on this. However, leverage is coming down in line with a better macro. This slide on emerging market defaults, you can see emerging market high yield default rates is the green line versus the US in orange and European defaults in blue. This is, to me, the biggest misconception, if not cliché, in the asset class from investors. I have clients regularly telling me, yeah, emerging markets great, but you're taking more default risk by investing in EM than in other asset classes. If anything, looking at that chart, two highlights. A, emerging market defaults follow economic cycles, and B, they're very much in line with European and US high-yield defaults. The other question is recovery values. Are we, when we experience a default, are we getting paid more? Do we recover a lot on the investment in EM versus European and US investments? I've done an analysis of, in the past 15 years, default rates and recovery in the asset class, and it's very much in line with the recovery rates in US high yield. It's about 30 to 35% average. Yes, you're taking jurisdiction risk. Sometimes some countries, namely, for instance, Indonesia, Brazil, are not creditor friendly and much more shareholder friendly, and recovery values can be lower. But overall, across the asset class, you have countries like South Africa or even China, where we had few defaults, but historical evidence shows that recovery values are higher in China than elsewhere, and you're getting the same risk. A little bit on the Fed, so I told you the fundamental backdrop is good in EM. It's stabilizing to improving in terms of sovereign balance sheet, corporate earnings. However, one of the main risks in the asset class is a technical risk, and is the Fed, monetary policy in the US. We agree that if the Fed is behind the curve, the asset class is not pricing in that risk. So EM debt will be sensitive to a Fed that hikes faster or more than expected. That being said, it's not our base case. Our base case is that the Fed, we have a pretty consensual view about the Fed, and we think the Fed will continue to hike progressively and in line with consensus. And in this case, the asset class is pricing in a lot of the bad news. Remember, during the taper tantrum in May 2013, we had a lot of outflows in the asset class on fear of the end of easing in the US. And across the years from 14 to now, the asset class has actually performed quite well, and we think it's priced in. If you look back in history, in the years 2000, when the Fed hike rates in the US, EM debt had a good run during this period. So it's just a matter of whether the Fed is behind the curve or not. If your view is that the Fed is behind the curve, I would say wait a little bit, because it's not the right timing for emerging market debt. The problem is that I've been hearing this from clients in the past 3 years, and they've missed on a lot of performance in the asset class. Also, importantly, you have countries like India, which is a closed economy, doesn't have external debt, so the sovereign does not issue in hard currency sovereign debt. They would be potentially very immune to a Fed hike. And Eastern European countries like Macedonia or any Eastern European countries which fund in euro and are less sensitive to a Fed hike. On the other hand, the Fed, when the Fed hikes, it has a direct impact on countries like sub-Saharan African countries which have shorter dated bonds and high refinancing needs in dollars, and any Fed hike has an impact on those countries. So what matters to us is not so much the Fed hike, but also the shape of the US Treasury curve. Remember, emerging market issuers like Russia or Brazil, when they issue a bond in the market, they issue a 10-year, a 30-year. Whether the Fed hikes in the short term doesn't really matter as long as the 10-year or 30-year bond don't move. Recently, we've seen a move. It's going to impact them when they refinance. But again, think more about the shape of the US Treasury curve rather than the hike in the short term. So the problem in EM hard currency, and here you can see credit spreads in the hard currency sovereign bonds in blue and corporate bonds in green, is that this improvement in macro fundamentals in corporate earnings, lower default, is priced in. So you've had a massive rally from 500 bips to 250 in the past 18 months or so. So yes, it's priced in. Where are the spreads going from now? That's the real question. We think, as I said, a lot is priced in, so you're unlikely to see spreads in the hard currency space continue to tighten significantly. Yes, there are flows in emerging market debt that are higher than supply of bonds, so it continues to drive spreads tighter. Just bracket, what happened in the past 2 weeks for emerging market debt was insignificant. It was only a 20 basis point widening, which honestly I had a lot of brokers calling me, oh, are you buying the dip, etc. No, it's not a dip. The 20 bips widening we had in a couple of weeks were just back at the levels at the beginning of the year, 1st of Jan this year. So it's not a dip and it's not a real sell-off in the emerging market debt space. So spreads in the hard currency space are, if not fair value, a little bit expensive, but the fundamental backdrop justify this level of spreads. So where are we finding value in EM debt? Mainly in local currency currently. And this is why we have a flexible bond fund. The mandate allows us to go from local to hard or hard to local, sovereign to corporate, and we like local currencies. This chart, which is the beer model of valuating currencies, shows you that approximately 70% of the current EM currencies are undervalued. Not only do we find value in some currencies, but we also find value in local currency bonds. in rates. If you look at how elevated most real yields are in emerging market currently, we find value. When I say real yields, it's basically nominal yields adjusted by inflation expectations in those countries. If you had looked at this chart and the previous one back in May 2013 when we had the taper tantrum, currencies, most of them were overvalued and real yields were much lower, if not negative, for most of them. So what I'm trying to tell you is that, yes, we're seeing flows like we had before the taper tantrum, but the fundamental backdrop and the valuation on local currency is way different and much better. And you can see that in terms of yield, so this is yield in EM sovereign bonds in local currency in green and in local currency in orange and in hard currency in green. You still have a decent yield pickup over developed markets. The real question is, are we paid for the extra risk we're taking? Yes, we think that given fundamentals are stronger, the differential makes sense, and we're still getting paid in emerging market debt at the moment. A little bit on flows, because I mentioned the Fed is one of the risks in the asset class, and the other risk is flows. This chart shows you flows into emerging market, and not only flows in equities and bonds, but also it includes foreign direct investments. And this chart is great news. It means investors invest in emerging market for the good reason, for growth. You can see whenever we have growth, flows pick up, and whenever there are recession, flows come down. The bad news is this chart. This chart is only flows in emerging market, hard currency, sovereign, and corporate debt. So not local. You can see back in 13, we had massive outflows in the asset class, but since then, since the beginning of 16, we've recovered most of the flows. The problem is not so much that we had flows for the good reasons, which are improvement in fundamentals and good valuation. The problem is how much of those flows are yield chasing only, i.e., developed market yields are so low that we have non-dedicated EM investors chasing yield in the market, regardless of fundamentals. So this is not a red flag, but I would say it's an orange flag. It's something to watch. If we continue to see flows overheating, a reversal could be painful. So that was on the macro section. Let me talk a little bit of the portfolio. You can see on the right-hand side, the pie chart. This is our neutral position. So basically, should we have no view, the portfolio should look like the neutral position, 1/3 in sovereign bonds in dollar, 1/3 in sovereign bonds in local currency, and 1/3 in corporate bonds in dollar. Currently, actually, the look of the portfolio is better on the next slide. Currently, you can see we have, on the right-hand side, we have increased local currency at the start of 2016. We have increased local currency towards about 40%, 40. The weight of the portfolio, 40% is something, but remember in terms of risk, since local currency is more volatile than hard currency, 40% of local in weight is probably somewhere at 50, 60% in terms of risk in the portfolio, to give you a sense of where we are in terms of local currency. The decrease in corporate bonds was basically at the expense of the increase of local currency sovereign bonds. So hopefully that makes sense to you after what I told you on valuation. We find we find local currency more attractive currently, hence our increase in the local currency space. The flexibility of the fund is very important. As you can see, when local currency underperformed during 2013 to 2016, we were underweight. should we have a benchmark or non-flexible fund, we wouldn't have been able to navigate through hard times in EM. Little bit on duration. So I told you we have quite a consensual view on duration, so we're not underweight duration for the time being. Emerging market debt is one of the steepest asset class in terms of credit spreads, and we like to get the spread in the long-dated bonds, and we hedge back the duration at the portfolio level through futures. We're still getting paid for taking some duration risk in EM debt. That being said, we're just about our neutral position, so we're shy of 5.5 years in terms of duration. Little bit on exposure and currencies. I said we like the currencies and the local bonds, so sometimes we do it through just forwards of the currency or just by the local bonds. What we like, so Singapore dollar, which is the biggest exposure, is actually more a cash proxy instead of being in treasuries in terms of return. So forget about this one, but we like Russian ruble, still Brazilian real. We still like India and Indonesia as well. So a number of currencies, I think like Claudia, for instance, a year ago, started a position in the Egyptian pound local bonds after the devaluation of Egypt. There's always a good, it's a broad market, there is always opportunities. And we're a high conviction fund, so when we increase local currency, we don't buy all currencies, we buy currencies exactly like we buy corporate bonds. It means it's a bottom-up call and it will be at it needs to be a conviction level. Little bit on positioning. I think what's important on this slide is we're not mainstream. We're not here to be invested only in the big countries, namely China, India, Brazil, Russia. You can see the other weight. We like niche countries. We like specific names where we find value. We're not afraid, we're not benchmarked, and we're not afraid to be underweight in the big countries. If you look at the underweights, China is wrong on this slide. It's not 0, it's 0.7 because it's Hong Kong, it's a Hong Kong holding, so it doesn't show as China, but it's still very underweight. We're clearly underweight in Asia. Not that we think that China is going to face a hard landing. We don't like Chinese debt and fundamentals, but we don't think either that China is going to blow up. We don't like China mainly on valuation. Basically, we're not getting paid for the risk in China. We find better value elsewhere. Nigeria is one of our strongest conviction, lower level of debt in Africa compared to other countries. The currency is getting more liquid. The country is adjusting to the new oil environment, and a couple of other weights like Ukraine. Finally, on the emerging market bond fund, you can see in terms of geography, we have, as I said, Asia. The underweight versus our neutral position is mainly due to our underweight to China. And where we are punchy in the portfolio is sub-Saharan Africa. I mentioned Nigeria, but we are also invested in Zambia, for instance, which is highly reliant on copper prices, and other countries. So to wrap up, improve fundamentals in the asset class, stretch to fair value valuation in the hard currency space, however, opportunities in local currency. The flexibility of the fund allows us to navigate through this environment. And it's much easier for me to be in front of you today than it was 3-4 years ago when fundamentals were really poor. Today, the story is much better. We still have some risk, flows, and the Fed, if you have a different view than ours. I'd like to spend just a quick couple of minutes on a new fund, which is quite exciting. We've launched that new fund, which is an emerging market multi-asset proposition back in May 2017. So I work with my EM equities colleague, and we do, if you're familiar with the Optimal Income Fund, we do kind of a similar arbitrage within companies in emerging markets. Namely, we do take views on whether we should own the equities or the debt among emerging market companies. It's an income product, so our objective is to deliver 4 to 6% per annum, and obviously grow capital over the long term. The beauty of the fund is the fact that if you're familiar with emerging market equities, there is a strong bias towards China and Asia. In bonds, it's much more diversified, and as I told you, we don't find value currently in Chinese credit. So by mixing both asset classes, we're able to get where we find value in credit while still getting the growth story in Chinese equities. And the difference is that if you buy a pure EM corporate bond fund and a separate EM equities fund, you might end up with concentration in terms of sectors, concentration in terms of countries, which we filter by managing both universe. We're able to diversify your investment in terms of currencies. Obviously, EM equities are in local currencies, and EM corporate bonds are in dollar. So you have a balanced currency in the fund. And we have a balanced diversification in terms of countries and in terms of sectors because we manage it. Plus, if you're not too keen on having duration, EM corporate bonds by nature have a lower duration and equities have none, although there is an impact. So the duration of the fund is much lower. I'm going to end up here. If you have interest for the new proposition, I'm sure our sales team or myself will be happy to answer your question, and happy to take any questions on the flexible bond fund as well.
Hi. When you like a country in your fund, how do you decide whether you go with a government bond or a corporate bond?
Thank you. Yeah, it's a very good question. So first, the beauty of the fund is that once we have a conviction at a country level, which prevails over bottom-up to us, the beauty of the fund is being able to diversify within a country between hard local, sovereign, and corporates. So if I take an example, Argentina, we have Argentine sovereign hard currency debt, local debt, provinces of Argentina, and a few corporates in hard currency. How do we decide the weights? It depends on the conviction on the credit fundamentals. What is the call on fundamentals? Liquidity as well. Corporates tend to be less liquid than sovereigns. And how much, in particular in corporates, how much are we getting paid over the sovereign? What we call spread over sovereign analysis. Once we're comfortable with this analysis, we will decide on the asset allocation within a country. Just to add, this is very important. The fund is a blended approach of top-down and bottom-up, but the top-down always prevail. If I take Argentina, back in the early 2000s when Argentina defaulted, all corporates in Argentina defaulted. More recently in Ukraine, when Ukraine defaulted, all corporates except one defaulted. So we were very mindful of it, so the macro call is always prevails on the bottom-up.
¿Alguna otra pregunta? I have just one, then the last one. Is how do you see the political risk or political changes that may occur in Brazil and Mexico with elections? Does that affect the way you are investing?
So it's a bit early to call on the election, Brazil in particular, because Brazil is, I think it's October. Mexico, I'm not even mentioning Russia next month because we all know what's going to happen. Mexico, actually, we have a different view from the market. And that's mainly Claudia's view on López Obrador, which is leading the polls in Mexico by about 10 points, I think, or even more. I personally did an analysis on polls over the latest 4 presidential elections. It's impossible to read results based on historical evidence. If López Obrador, AMLO, is elected, we don't think he's going to be as disrupted as the market think. He was mayor of Mexico City for a long time. He's done a decent job in Mexico City. Yes, he's left-wing, and by nature maybe less favorable for capital markets, but we don't think it's going to be disruptive for capital markets in Mexico. We've seen other left-wing presidents in Latin America, Lula in Brazil, and Brazil's done pretty well during that period. I'm not entering into the discussion on Lula now. So we think the market is not pricing in a breakdown of NAFTA and a full election of AMLO. That being said, if López Obrador is elected in Mexico and the NAFTA situation remains stable, that could be a good opportunity for us to go overweight Mexico, because we don't think it's going to be as disrupted as most people think.
Okay. Thank you very much.
Thank you.
Llegamos a la última presentación.
We come to the last presentation today on Japan, M&G Japan Fund. We have Johan Dupries, who's the fund manager. Johan manages the fund. It's a very old fund. It was launched in 1971.
Desde septiembre de 2000.
Johan has been managing it since September 2015. Over 600 assets under management. It has 5 Morningstar stars. And he's also the manager since September 2015 of the Japan Smaller Companies Fund. It's a highly concentrated fund. And if you want to see something slightly different about Japan, because as you know, for many years, Japan has been a disappointment for the markets, but Johan believes there's a structural change now. The fund, ever since he's been managing it, has exceeded the benchmark, and the small cap fund did a little worse. He's been working for M&G since July 2015. He's South African. He used to work for PPMA, which is the South African Prudential Portfolio Management Company. He worked in Asia for Prudential. He is an expert in Japanese and Asian equities, and I hope he will change your perception on this asset class.
Ladies and gentlemen, I'm going to stand here because I'm quite short. Thank you for taking the time to listen to the M&G Japan team's story today. Today, I'm going to talk a little bit about the nature of the environment we're observing, or have been observing for some time in Japan, and what it might mean for the active management problem. Our team has delivered a reasonable outcome, a reasonably consistent outcome for investors over long periods of time, and also quite recently, as you can see from the graph. Both the all-cap and small-cap fund has handily beat their benchmarks and also kept up with a lively competitive universe. So what is it we've seen? What is it we are seeing in the market today? I'll observe that most of the market is enjoying the price rise in the topics and the small cap specifically universe in a grudging way. It has enjoyed this delivery of this performance, probably not quite understanding what's happened here. And most of the beliefs we see or hear in the market today is framed in observations that are probably 3 decades old. And I'm going to talk a little bit about those observations later. How has performance been delivered in the broader market? I have a love-hate relationship with factor strategies. They're extremely good at telling you how returns have been generated in the recent past or over periods of time. Not so good at telling you how returns will be delivered in the future. But in this instance, a breakdown of returns by factors will show you that in 2016, value strategies had a fantastic time. What that doesn't tell you is that fantastic time was confined to 2.5 months from middle October to December. It was a torrid time for most strategies in that period where quality did reasonably well. Last year, momentum, or as I call them, return-chasing strategies, just get me some of that return, I don't know what it is, but get me some of that, did very well. The same value strategies, not so much. And you can see here that quality did quite well as well. Okay. So how then did the Japan equity team, with a value bias, I'll be upfront, we have a value bias, manage to outperform the market, both our universes, in what can be described as a tough environment for value? Okay. It starts with an observation that despite the price appreciation we've seen, our universe, small and large, is still cheap. Right? Valuations are still attractive. And this valuation is well supported by a regime shift that has been in the making for almost a decade now. And what do I mean by that? When we think about a market or our own decisions, it is well placed to understand the context in which the beliefs, our own beliefs, are formed. Typically, long-term trends tend to drive our experience of the world. It does so in a direct way. For instance, in the market, we all experience inflation on a daily, monthly basis, begrudgingly. So I was not happy when I just bought my train ticket and paid £10 more when I know productivity has gone down 25%. That's inflation. We also experience it indirectly in the form of asset yields. Ultimately, asset yields determine the wealth we have at the end state when we harvest our investments over a lifetime. Today I'm going to talk a little bit about how this impacts our sense of the way the world should be. We experience this daily. It gives us an intuitive sense of the way it should be. The more profitable this experience has been, or costly, the stronger we are onto this belief. Take inflation. On this graph, you see, going back, on this graph you see long-term inflation expectations in Tokyo. Coming out of the 87 crash, 2000s, the belief was we're going to sprint a 3% inflation number. Reality, as shown by delivered inflation, was quite different. It took the market 14 years to adjust to a world of deflation, and then only grudgingly. And the core message here is our cherished belief about the way of the world, or the way the world is, takes a long time to change when facts change. Why? Because it's quite often emotional content that supports those beliefs. Okay. So what does this mean for Tokyo today? A brief survey of the markets suggests the following is what the market thinks, or the world thinks about Tokyo. Yes, Tokyo has adjusted via deflation. Ignoring the fact that we're seeing increasing signs of inflation emerging, specifically wage inflation. Ignoring the fact that the deflator is no longer minus 1%, it is now positive. Company management don't care about profits. Well, the extraordinary delivery of profits, which I'll talk a lot about going forward, is only grudgingly acknowledged. They don't care about shareholders. We've got a governance code. We can have conversations now with management with delivered outcomes, which we haven't been able to have for 15 or so years. Okay? This is the one that hasn't changed much. It's beta play. Buy when it's gone down a bit, sell when it's gone up a lot. That hasn't changed very much. And then lastly, Abenomics hasn't worked. Until about the end of last year, the market was of the view Abenomics hasn't worked, expressing a frustration with we've had this extraordinary quantitative easing, but we've only seen a small print of inflation. rapidly followed by a mini taper tantrum as soon as the BOJ didn't arrive and spend the full amount of allotment in the 15 to 25-year bucket as promised. Okay, that was quite interesting. So those are beliefs held widely today that are challenged by facts. And the facts is profits. What about context? Japan has been extraordinarily successful at lifting it up from its bootstraps post the Asian or the financial crisis in 07-08 and actually delivering now 9% operating profit margins. 9% operating profit margin. For much of my career, we were used to industrial companies printing 4 or 5%. That is a significant change. And this at a time when economic activity is still well below what we saw in the 05, 06, 07 period. So what's going on here? Well, put short, this near-death experience in 07, 08 galvanized a change in attitude to legacy businesses, businesses that have become somewhat uncompetitive. And we saw swaths of the Sonys of this world deal with those legacy businesses and dropping their fixed costs in a structural sense, becoming competitive. We saw a reallocation of surplus investments to some sound investments on a more global platform, building distribution platforms, building production platforms that are somewhat inured to the yen in terms of competitive dynamics. The market's only grudgingly acknowledging this boon for shareholders. Right. So that's an entrenched belief the market holds. It doesn't care about shareholders. The existence of the governance codes means that myself, my team, and every other investment in Tokyo can walk into a room and have a constructive negotiation with management. It's extraordinarily profitable business, this. You're printing a 10, 12% ROE through a cycle. Why is your payout ratio only 10%? Which is why we own many businesses now paying out 50 to 100% of their earnings or cash flow. This has been a surprising journey for even myself. I did not expect to see this a few years ago. So this is another tool for us to extract value for our investors or unit holders. And what has changed? Well, as I alluded to, it's the governance code and it's the stewardship code which forces parties to have a conversation which never happened before. Okay. Problems with factor strategies. This world in which earnings are exhibiting non-mean reverting characteristics is somewhat challenging for investors who are used to putting a 4 or 5% margin in the analysis. Oh, companies just had a bad outcome, 4 or 5% over time, put it in. It's somewhat challenging, as shown by this graph. Now, what is this graph? It is a histogram of price to book relative to the investment universe for every single stock in that universe over a very long period of time, say 20 years. Names towards the left are names that have somewhat derated versus their history. That's all we can say. The markets like them less. For some reason, the market's willing to pay less for those assets. Names to the right have re-rated. I've then plotted 3 snapshots. September 2016, being the red line, beginning 2017, end 2017. And this is the small cap universe, to be precise. And you can see a gradual re-rating of the universe over time. What is happening here? Companies who have delivered successful outcome for investors, Sumitomo Hemi Industries, have undergone significant restructuring over the last half decade. Companies like that should re-rate versus peer groups of companies that may be less successful. So coming into this, I was expecting to see some of this drift. Here we see something else I'll talk in a little bit. We are starting to see some excesses of inappropriate risk-taking in the market. And funny enough, it's the same as any other market in the world. There are always some excesses, some opportunities that provide the seeds for future investment opportunities for myself and my team. If I look at the large cap universe, same story. Okay. So signs of complacent risk pricing, where we've seen a significant decline in risk preferences or the market's willingness to pay up for perceived successful businesses. Unsurprisingly, bond-like earners, where you've got the a feeling of there's some comfortable delivery in earnings here. Mark's been prepared over the last 5 years through the deflation cycle to pay up for these earners. There's a preference for a select number of technology stocks, which is significantly rating. SMC, Yasukawa, Omron. It's not a very long list, but it's a list. They have all outperformed Netflix, Amazon, Facebook over the last 3 years. The earnings growth hasn't. Okay. So that is all about, get me some of that return. We're not going to ask too many questions about what's going on at the bottom. It is return chasing at its worst. And then the preference for construction-type names in Tokyo, because we've got the Olympics, and there's a certain set of earnings that will emerge over the next 18 months. When I ask management teams, what then? I'm greeted with a nervous smile, because nobody knows what's going to happen when that order book does that, which it almost certainly will. So we see a preference still in the market for what can be described as low-risk earnings, where there's a sense of certainty, at least over the short term, in the delivery of outcomes. Whereas the market still is willing to ignore good, sound management practices, which has delivered extraordinary outcomes. Ibarra is a company we owned. Has restructured its domestic business where the margin has gone up from the sleepy 4-5% regime to now 9%. Market's not pricing that. Okay. So in summary, what do we observe from this world? Facts, as they stand today, are challenging our entrenched beliefs. They're challenging my beliefs. As a manager of some experience in this market, going 15 years now, I never dreamed I'm going to see 9% margins, but it's a fact we have to acknowledge. Valuations, well, valuations before the recent sell-off was attractive, they're more attractive today. Factor strategies are challenged here. If your idea of exploiting valuations using a statistical arbitrage technique that would rely on mean reversion, you could feel lonely and sad for a very long time. This is still a healthy environment for active management because despite observations to the contrary, I can objectively prove there is substantial breadth in this market. This is a healthy environment for active managers to extract alpha, which we continue to exploit using our proprietary approach to extracting value from excess risk premium. And what do I mean by that? Okay. So how do we approach the active management problem? Typical approaches to the active management problem start with information. Whether you're a quant strategy on the one hand, and you mine available data or increasingly social networks, observations around the evolution of news, or you're a traditional fund manager who tends to work in the forecast space, where you think you can forecast twists and turns in earnings. The observation here is if we have some concept of how information might emerge, we can say something about fundamentals and then profits. This is a world in which people and the market thinks all is knowable. Contrary to that world, my team and I think the market is not knowable. It is actually profoundly uncertain. And at best, our analysis is an attempt at storytelling to make sense of a world where we're profoundly confused most of the time. Quite frequently, our beliefs about a stock or a name or an asset class is surprised when something happens we did not foresee. Quite a few names in the last few weeks have gone down 10-15% when the market started realizing there might be wage inflation in the pipeline. That wasn't in the model 6 months ago. These shocks or surprises cause a significant dislocations in the market's sense of certainty and the price we're willing to pay for an asset. Right. If that was all going on, I could write you a Python script. We could drop costs in the business and just let this thing run. But that's not what's only happening in asset pricing. In a world where we're profoundly uncertain about the nature of the asset pricing mechanism, when we observe price move using the same information as our competitors, unless, of course, you use inside information, you tend to see a drift in your own beliefs. You tend to be challenged in your own beliefs, and you get a recursive relationship between price and risk preferences develop. This is where emotions take hold. This is the world where my team and I exist. We patiently wait for the market to be surprised. We patiently wait for the narrative to overtake the facts. We patiently wait for emotions to drive a significant wedge between price and some concept of value. So how do we do this? Because after all, I'm human. My team are made up of human beings. We are quite fearful at times when we build positions that can be up to 4% of our NAV. We have agreed on a very simple framework which asks somewhat tough questions at hopefully appropriate time. And this framework underpins our judgment. So if I go into the details, you'll see there's some significant quantitative techniques in the background. We don't outsource our judgment to those tools. They serve one thing and one thing only, one purpose and one purpose only, for us to make judgments about the nature of price we're observing. Out of this, we seek to build a portfolio of best ideas that is reasonably diversified. You heard that right. It's a very important concept, be reasonably diversified. We are willing to dynamically allocate capital as and when we see opportunities. So we won't just buy a name and hold it forever and a day. If it goes up, and they quite frequently do, we'll sell it and move on to the next idea. If there's a big dislocation in the market, we'll use the inherent diversified nature of the portfolio to exploit that opportunity. And we manage risk proactively. In a fund where you hold 30 to 50 names, you have concentrated active positions, an active share of roughly 86% for the all-cap fund. If things go wrong, they can go wrong horribly. If you think the market is pricing earnings power over a year, but probabilistically it's somewhere over a year, and you're wrong, you need to have a strategy to deal with that because we make mistakes. So in this process, embedded in our fundamental analysis and our review and control part of our process, we consistently review our core assumptions embedded in our valuation work, embedded in our understanding of companies, and ask, are we being challenged here in a profound way? Is the capital here allocated appropriately? So that's by way of the portfolio. So what have we done over the last year? This is a brief snapshot of the portfolio. January 2017. The y-axis shows our active weights, and you can see they're quite significant, of the biggest holdings in the 10 biggest holdings in the portfolio, and then the rest of the portfolio. The x-axis shows some proxy for objective value. In this case, price to book versus the investment universe versus time. Now, we have a couple of versions of this. We plot this versus enterprise value as well, and we plot this versus our own sense of intrinsic value of the names we own and names we are analyzing. This is the change. We have been busy. There's been considerable cross-sectional volatility in the market despite claims to the contrary, and we've used that to profitably exploit those opportunities for our unit holders. For example, Ybarra makes large-scale industrial pumps. It's its main line of business. There are only 3 competitors globally, including Ybarra in the space. It's an oligopoly, really. GE, Siemens, and Ybarra. Coming in to February, March 2016, this stock derated significantly. This at a time when the market was asking questions around the oil demand from the oil and OTCG sector. Forgetting, of course, that it's only 20% of demand for Ybarra. There were significant fears around pricing discipline in this business over the next couple of years. If you demand this stuff, they're going to start undercutting each other on selling hardware. We did significant work. We actually did significant work running up to this. We didn't expect this price event, but it was quite handy. It was one of the tools we have at M&G is a very experienced bank of analysts. And our brief to our industrial analyst, Mr. Chris Yule, was very simple. Are the competitors, being GE and Siemens, going to engage in significant competition? Chris had just or was in the process of meeting these CEOs and CFOs. And the message after a few conversations that came back was no. So it doesn't mean it wasn't going to happen. It meant the probability of that outcome was low. So we bought a significant holding in this portfolio. in our portfolio in February, March 2016. Why? Because a large part of the earnings is a very steady service business. You have to continue servicing your pumps even if the economy or demand for oil falls. Otherwise, you shut your business. So that was a steady earner which supported the valuation. You can see the evolution of price here. The stock went up a lot from the lows where we bought it, and we sold it. Why did we sell it? Because the market had repriced the risk associated with these assets in a profound way, and we found better idea elsewhere. And that is how our operating code. We make a lot of money for our investors by exploiting concerns here. And then when the market reassesses its risk preferences and readjusts its risk preferences, we sell after we've made a lot of money. You can see we exited quite quickly. All right. A few more minutes, so maybe one more example. Chiyoda. What does Chiyoda do? They're a plant engineering company with a speciality in large-scale chemical plants and specifically LNG terminals and the like. Coming out of 2014, the market was somewhat concerned about the energy cycle and future demand for this business, especially given one of its big orders was reaching maturity, building the Ichthys plant for INPEX. So we observed this patiently. I saw the company a few times, and John saw the company a few times. We did our work. Then something happened in back end of 2016, which we didn't think. Chiyoda has always wanted a third pillar of growth. And it had thought that it could supply pipes into the plants it was building on offshore platforms quite profitably. And it invested in building this subsidiary domiciled in New York. It turned out they misunderstood the competitive nature of that part of the business, and this business went bankrupt. The market didn't like that one jot. Implications for the balance sheet was minuscule. It was a JV with no liabilities on the balance sheet, so there was no real cash implication for investors. We used that episode to build a significant position because there were three observations that were key here. The competitive environment had changed profoundly. Their Korean competitors had all but destroyed their balance sheets through the last LNG cycle. Why is that? Because they bid too competitively, and delivering on those plants became somewhat of a nightmare for shareholders. The US competitor is now doing very profitable work for the US government and has abandoned the sector. That leaves two Japanese companies to address demand that is of the same size today as we saw in the last cycle. I'll let you imagine what that means for margins. Why the sudden reassessment in risk preferences here? Because a number of Arabian countries announced that, we need to become more green in our energy consumption, and we're going to build LNG manufacturing terminals. Demand just grew by a lot. The market reassessed the risk of these companies. All right. Okay, so I'm aware, and I'm standing between you and cocktails. To summarize, our approach is durable. It's differentiated. Why? Arbitraging human emotion is hard. It's not easy. This team is very experienced. John and I are old hands at Japan. I've been investing in this way for almost 20 years now. I'm not new to doing this, nor is John. We have a disciplined framework that is simple and repeatable, that allows us to ask tough questions. At times we'd rather not ask those questions. And this allows us to extract alpha at difficult times for our investors. And I'm going to stop there. Thank you very much for your time today. Questions? Thank you.
¿Alguna una pregunta aquí?
One question here.
So when we're talking about large cap,
Cuando hablas de grandes empresas, large cap, y de Small Companies Fund, cuando piensas en empresas grandes y pequeñas, small cap y large cap, uno suele pensar en empresas europeas, estadounidenses, pero sé que en Japón no es igual. ¿Por qué debo invertir entonces en este fondo large cap o small cap, o por decirlo en otras palabras. Si quiero invertir en Japón, ¿debo comprar ambas? Si compro el fondo de small caps, ¿cuál sería mi objetivo? Lo mismo con las large cap. Bueno, vamos a posicionar primero los dos productos. Por definición, estamos hablando de todo el espectro de capitalización bursátil, o sea que compramos grandes empresas y pequeñas. Y todos siendo conscientes de la liquidez. Los nombres poco líquidos no accedemos a ellos. Los small caps, el fondo small caps, bueno, pues tiene en cuenta empresas de baja capitalización bursátil, pero la liquidez ahí no es tan visible. Hay bastante riesgo en ambas carteras, porque la manera en que construimos una cartera es creando una cartera con episodios razonablemente diversificados. En el mundo de small caps podemos encontrar ideas muy interesantes, bastante laterales, o sea que ahí hay mucho riesgo idiosincrático. Si piensas en la asignación de riesgo, bueno, pues en el fondo small cap hay más riesgo que en el otro. Si quieres exposición a Japón, entonces, por supuesto, compra cualquiera de estos fondos. Si quieres más riesgo idiosincrático, pues el small cap. Bueno, a la hora de decidir qué nombres metemos en la cartera, pues es igual que en cualquier otro fondo, simplemente que accedemos a estos nombres en distintas partes del mercado. Any further questions?
Johan. Con esto acabamos.
We've come to an end. And before ending our session, please do fill up the form for your feedback, because it's really useful for us in order to improve future meetings. Thank you very much indeed. I would like to thank you for your presence. I hope you had an interesting talk about multi-assets, etc. If you've got some questions, we will be together having a drink and a cocktail so we can answer your question. Thank you very much.
Give some meaning to your words. I can't read you anymore. Help me find some inner peace to survive throughout this world. We lead our lives in different ways. You never said too much before. I've waited oh so long for you to tell me something that will make me stay. Tell me something, it's so hard to say. Something before I walk away. Just tell me something. Red and orange on the wall when the day is almost gone. The horizon seems so close, only steps behind the door. And no one could say who's right or wrong. The answer will hide from us once more. Chains are untied, it's up to you.